Where to write now? This one. Yeah, good evening. Where to write on the
Okay. Need to do this.
YouTube have to minimize some, right?
Okay.
No. இதில் எந்த மினிமைஸ் கொஷின் இருக்கு? இல்லை எழுதுறது வரலையே.
இல்லை அதை எடுத்துகிட்டு போதும். அதான் இது கிளிக் பண்ணுங்க, இதுக்குள்ளே கிளிக் பண்ணுங்க. அடுத்து ரைட் பண்ணி இது மினிமைஸ் பண்ணுங்க. இது மினிமைஸ் பண்ணுங்க. எஸ் இதில் எழுதுங்க பண்ணுங்க டாக்குமெண்ட் தானே. ஓகேவா?
Good evening, my dear students. I am checking. Just a minute, Kana. Just wait for 2 minutes, my dears. எதில் எழுதணும்ப்பா அதில்? Can I write in Word document? இதில் எழுதலாமா? பட் வேர்ட் டாக்குமெண்ட் என்ன ஸ்பேஸ் இருக்குங்களா? அப்போ இங்கே என்ட்ரு கொடுத்து எழுதிக்கலாமா? அப்போ எழுதுறது தெரியுதான் எப்படி பார்ப்போம்? இப்போ எழுதுறது வருதாப்பா? Okay. Yeah.
Okay, sir.
What I am writing is visible or not? The front load.
10 seconds. No, he just wanted to check whether whatever he's writing is displaying on the screen or not. That's
Okay. எழுதுறது தெரியுதா?
yes.
Okay. ஒரு ஸ்டாண்ட் வச்சுருக்கோம்.
ஓகே. ஜூம் வந்து இன்னும் ஃபுல்லாக கீழே இது பண்ண சொல்கிறாரு. ஜூம் ஒரு டாக்குமெண்ட் 130 115 இருக்கணும். இந்த ஸ்க்ரீன் இந்த சைடில் போய் கேட்கலாம்.
Is it okay now?
Perfect. Okay.
I think is it okay, am I right? Shall I start or no?
Yes, please. Yes, sir. No, I have just adjust the monitor itself.
Yeah.
Chat box open as well.
Okay.
So students are going to
So, very good evening, my dear students. Hope I am audible. Shall we start the session? Can you respond through chat so that I can understand whether I can able to communicate properly or not? Am I visible, all of you? Yeah, dear students, am I visible?
One minute.
No. Thank you, Jagan. Sangeeta, thank you for your response.
Okay.
Voice clarity is okay, all of you?
No, better than that.
Voice clarity is okay? Yeah. Good. Yeah. Good evening, my dear students. Welcome to Powerhouse Super 30 program. Today's session, SPOM in the Strategic Cost Management, Strategic Cost and Performance Management. CA final costing paper. The 2 days program, we are going to have quick revision of how to handle CA final costing paper. Yeah. Thank you, my dears. Thank you for your response. We'll start our program. Already got delay. Sorry for the inconvenience for starting the program. We'll go. First question. Compute the market size and market share variance based on the following data. Particulars for the company, overall market or the industry. Question is visible, all of you? Yeah. from the particulars, budgeted sales quantity 10,000 quantity, whereas overall market or the industry 50,000 units. Actual sales for the company 11,000 quantity, for overall market or the industry comes to 68,750 units. Total contribution comes to rupees 1560 lakhs, rupees in lakhs. This is what the available data. This question is based on standard costing, advanced level standard costing, modern standard costing. This question is based on market size and market share variance. You are all familiar with the variance analysis. Expectation and the actual is called variance. Here, whatever the variance has happened, not mere because of the traditional approach called material variance or labor variance or variable overhead or fixed overhead. That alone is not the criteria for incurring the variance. In addition to that, other factors are also there for the purpose of variance. That is called market size and market share variance. So you should be in the position to know what is called market size variance and what is called market share variance. Market size represents size of the market got increased. Because of that, company may going to face some problem or company may going to have some variance. Size means what? Quantum got increased. Market share represent, it's purely based on goodwill of the company. My quality of the product good, that's the reason variance has happened. It may be for positive side and negative side, based on impact on profit. Variance can be clustered into two types. One is called favorable variance, another one is called adverse variance. So based on impact on profit, you may going to get the variance here. Now, market size and market share variance. That is what you are going to compute by way of in this question. First, market size variance. With respect to market size variance, if you remember the format, easy for you to solve the problem. Sales quantity in overall market. Sales quantity in overall market. In that sales quantity, how much the budgeted quantity and how much the actual quantity, both we have to identify. This is with respect to what? Overall market. There are two things are there. One is called overall market, is called industry. Another one is called company. Industry is a broader terminology. Company is a small terminology. So, in this question, how much the budgeted sales for the overall market? 50,000 units given in this question. Whereas, actual quantity for the overall market 68,750 units. $68,750 is the actual quantity. So, budgeted quantity 50,000, whereas actual quantity 68,750. Difference comes to how much? Difference comes to 18,750 units is the difference. So, increase in sales quantity due to market size. Because of the market size, how much the quantity we got increase? 18,750, the incremental sales quantity due to market size. I'll repeat once again. We thought overall industry as a whole 50,000 product we can sell. But because of the market size got increased, total sales happen or total demand sales happen in the industry comes to 68,750. Therefore, increase in market size comes to 18,750. Industries is different, company is different. Out of which, what could be the company share that we have to identify? Industry as a whole 18,750 got increased. Out of which, my company shares comes to how much? How much it will get affected in my company? That is called my share. So, budgeted share, company's budgeted share, for our company's budgeted share, that to markets, in market, how much we have to identify. What about the budgeted shares? If you see the question, budgeted share of the company comes to, out of overall market 50, company's budgeted sales quantity comes to 10,000. If market size is 50, sales quantity for the budget comes to, budgeted sales quantity for the company comes to 10. Therefore, what is the percentage? Out of market, 20% for the company shares. In the sense, my industry as a whole 50,000 units can sell means, out of which 10,000 quantity sold by our company itself. Therefore, 20% is the share for our company. Same manner, if the market size got increased to the extent of 18,750, out of which 20% share we are having impact in our company's sales. So, if I am going to apply this 20%, 18,750 into 20% is equal to 3750 units. Kindly check it up the computation, my dears. 3750. So, this is an increase in sales quantity of the company. Company's increase in sales quantity due to market size. Because of the market size, company sales got increased to the extent of 3750 units. This is in unit, variance we have to express in terms of rupees. So, multiply with budgeted contribution per unit. With respect to budgeted contribution per unit, given in this question, total budgeted contribution 1560 lakhs. 1560 lakhs. Whereas budgeted sales quantity comes to 10,000. Therefore, contribution per unit comes to how much? 15600. 15,600 is a contribution per unit of the product. Budgeted contribution of the product. So, budgeted contribution comes to 15,600 rupees. So, per unit contribution 15,600. Incremental sales quantity due to market size comes to 3750. Therefore, market size variance is equal to, if you multiply 585 lakhs, rupees 585 lakhs. Since it's a sales variance, if sales got increased, incremental sales, company's sales got increased, am I right? If the sales got increased means it's favorable or adverse? It's a favorable variance. Understood logic or not? Clear? So, market size variance comes to 585 lakhs favorable. Hope you understood market size variance. I'll repeat one more time. Kindly listen and respond. Kindly concentrate. First step, overall market budgeted sales quantity comes to 50,000 given in this question. Market nothing but industry. Whereas overall industry's actual sales quantity comes to 68,750. Increase in sales quantity due to because of the market size comes to it increase to the extent of 18,750. Out of which company shares in the market comes to 20%. 18,750 to 20% is equal to 3750 is the incremental sales for the company due to market size. Variance you have to express in terms of percentage. So if you multiply with the contribution per unit 15,600, market size variance comes to 585 lakhs favorable. So understood all of you? Any doubt in 585 lakhs market size variance? Jagan, Sankita, understood kanna? Jagan, Purunjada, Suraj, good kanna. Shall I go to the next one? Yeah. Next we can go for market share variance they ask. Am I right? The second question, market share variance. Market share variance. Even further, if you remember the formula, if you remember the format, it's for you for market share variance. Actual sales quantity for the industry, overall market, nothing but industries. Industries actual sales quantity. We got 68,750. Overall industry as a whole. What about the market share? With respect to market share, budgeted share we got 20%. Am I right? Whereas actual shares, how much you have to verify? Actual shares, actual sales quantity 68,750. Whereas company's actual sales comes to 11,000. So what is the percentage? Overall industry 68,750. Out of which company's sales comes to 11,000. So 11,000 divided by 68,750 into 100 means how much percentage? You will get 16%. So when compared to expected share, actual share of the company got reduced. We supposed to get 20% sales out of the overall industry, but we got only 16%. Yes, Kana, 16%. Therefore, actual shares comes to 16%. Therefore, decrease in market share. Company's market share reduced to the extent of 4%. So, 4% got reduced means impact will be there in the overall sales to the company also. So, decrease in company sales due to market share. Because of the market share, how much share got reduced? 68,750 into 4% comes to 2750 units. Yeah, 2750 units. So sales got decreased due to market share of the company. But variance you have to express in terms of percentage. Multiply with the budgeted contribution per unit. Already we got budgeted contribution comes to 15,600. Therefore, 15,600 into 2750 is equal to 429 lakhs. Am I right? So, market share variance is equal to 429 lakhs. Since sales got reduced, it's called adverse variance. So market share market share variance of the company comes to 429 lakhs adverse. Understood, my dears? Any doubt in market size and market share variance? Hope it is manageable. Shall I go to the next problem? Now, we'll go to the next question. New Look Enterprises Limited has furnished the summary profit and loss account for the firm for the year ended 31st March 2012 along with that of previous years as follows. Yeah, thank you for your response again. Particulars previous year as well as current year, rupees in lakhs. Material consumed 160 lakhs, 231 lakhs. Wages 100 lakhs, 138 lakhs. Variable overhead 40 lakhs, 48 lakhs. Fixed overhead 20 lakhs, 30 lakhs. Profit 80 lakhs, 93 lakhs. Total comes to 400 and 540. Nothing but sales comes to 400 lakhs and 540 lakhs. During the year ended 31st March, there was an average increase of 10% in the cost of material and 15% in the wage rate. To neutralize this cost increase, the firm raises the selling price by 8%. You are required to analyze the suitably and prepare a statement indicating the factor responsible for difference in profit between 2 years together with their irrespective contributions. Yeah. Shall we try? 2 years information available based on the same. Yeah, year 1 and year 2's information available. Based on the same, we have to compute variance analysis. With respect to variance analysis, whenever you come across variance analysis, you have to remember the 2 rules. Rule number 1, identification of variance and draw the respective chart. Rule number 2, filling the blanks. The 2 rules we supposed to remember, my dears. Now, identification of variance and draw the respective chart. In that, material is there, labor is there, wages nothing but labor, variable overhead is there, then fixed overhead is also there, sales is also there. Therefore, all the 5 variants we have to prepare. Am I right? So, here we are going to learn how to prepare all the 5 variances. Rule number 1, identification of variance and draw the respective chart. Now, first one, material. Material cost variance can be classified into 2 types. Material price variance and material usage variance. Usage variance again classified into mix and yield variance. That concept of mix and yield applicable only in case of more than one category of material. If there is only one material, mix and yield not applicable at all. So here only one material, therefore subclassification not applicable. Formula 1 minus 2, 1 minus 3, 3 minus 2. 1, 2, 3 represent. 1 represent standard quantity into standard price. Actual quantity into actual price. Actual quantity into standard price. Okay. This is the format with respect to material variance. Similarly, you have to go for labor. Labor cost variance can be classified into 2 types. labor rate variance and labor efficiency variance. Efficiency further classified into labor mix and revise of labor efficiency, and labor efficiency can be further classified into labor mix and labor revised efficiency variance. Labor mix and revised efficiency variance applicable only in case of more than one labor. Here only more than one category of labor. Here only one labor is there, therefore subclassification is not applicable. Formula 1 minus 2, 1 minus 3, 3 minus 2. 1 represent standard hours into standard rate, 2 actual hours into actual rate, 3 actual hours into standard rate. This is with respect to labor chart. Next, next you have to go for variable overhead cost variance. Variable overhead cost variance can be classified into two types. One is expenditure variance, another one is efficiency variance. Formula 1 minus 2, 1 minus 3, 3 minus 2. 1, 2, 3 represent standard hours into standard rate, actual hours into actual rate, actual hours into standard rate. This is chart for variable overhead. Similarly, fixed overhead variance. Fixed overhead cost variance can be classified into two types. One is expenditure variance and volume variance. Expenditure and volume variance. All are able to follow my ideas? Kindly respond or you are live. Formula 1 minus 2, 1 minus 3, 3 minus 2. 1, 2, 3 represent actual output into standard rate, actual fixed overhead, budgeted fixed overhead. Thank you, my dears. Thank you. All along I used only Zoom platform. Now suddenly platform got changed. I am also learning how to write or how to communicate with the student. Sorry for the inconvenience. So this is with respect to fixed overhead variance. Lost sales variance. Total sales variance can be classified into two types. Sales price variance and sales volume variance. Volume again classified into sales mix and sales quantity and sales mix variance. That subclassification applicable only in case of more than one category of product, more than one product if you are going to sell. Here only one product is there, subclassification is not applicable. So formula 1 minus 2, 1 minus 3, 3 minus 2. 1 represent budgeted quantity into budgeted price. 2 actual quantity into actual price. 3 actual quantity into budgeted price. So up to this stage, rule number 1 over. What is rule number 1? Identification of variance and draw the respective chart over. Hope up to this stage are you comfortable? Am I right? Hope you are comfortable. Now, Next, you have to go for filling the blanks. Just a minute. Rule number 2, we have to go for filling the blanks. With respect to filling the blanks, listen here, my dears. The first one, material, we are preparing for the year 2. Year 2 actual material cost consumed comes to 231. So actual you can copy as it is. Actual quantity into actual price is equal to 231. Actual quantity into standard price. With respect to standard price, information given in this question. During the year ended 31st March 2012, there was an average increase of 10% in cost of material. So, current year 231 rupees in lakhs material cost incurred to 231 lakhs is after increasing 10%. Nothing but what? When compared to actual price, when compared to standard price, actual price increased by 10%. That is what the meaning. Am I right? So, material price got increased by 10%. So, when compared to standard price, actual price 10% hike is there. So, if you want to convert actual quantity to standard price, 231 lakhs is a 110%. But before increment, what could be the material cost? So, actual quantity to standard price is equal to 231 divided by 110 comes to 210 rupees. Nothing but when compared to standard price, actual price got increased by 10%. 210 plus 10% is equal to 231 will come. Understand the significance of 10% increase in material price? The next one is what? Standard quantity into standard price. The word standard always ends with the actual production. With respect to actual production, we have to identify how much the production first of all. With respect to production, sales for the year 1 500, whereas year 2 become year 1 400, year 2 become 540. When compared to year 1, year 2 got increase. If it is increased, it may be because of two different reasons. One is because of the price, another one is because of the quantity. Clear? How much the price got increased? Selling price increased by 8%. Therefore, 540 is after increasing 8%. Am I right? After additional 8%, 540 has come. Therefore, before incurring 8%, what could be the cost? What could be the sale value? So, 540 divided by 8%. 540 is after incurring additional 8%. Therefore, 540 divided by 108% is equal to what, my dears? 540 divided by 108% is equal to 540 divided by 108. If you put, it comes 500. Am I right? It comes to 500. Yeah. Before incurring quantity, before incurring price 8%, it becomes 500 means. So current year, without considering hike in price, 500 is a sales. Therefore, 40 become because of the price variance and 500 because of what? Quantity alone. So, in other words, last year 400 rupees, 400 is a sales, 400 lakhs is a sales means current year without considering price, 500 only supposed to be the sale. In other words, if I am going to consider 1 rupees a selling price, last year 400 units they sold mean this year 500 quantity they sold. Are able to follow or not? 500 quantity they sold, but price also increased by 8%. That's the reason instead of 400 to 500 become 540. Hope you are comfortable with respect to justification of 540. After fixed cost, after all the cost, if I am going to add profit, this is the sales kanna. Am I right? So previous year sales 500, 400, current year sales 540 means it's a combination of increase in quantity as well as price. So 400 become 500 plus additional 8% increase in price. That's the reason 540 total sales has happened. Now come back to material variance. With respect to material variance, standard quantity into standard price represent the expected quantity of raw material required for actual production is called standard. So previous year 500 is the sales. Previous year 400 is the sales. If 400 is the sales, material comes to 160. For 500 actual what's supposed to be, that is called standard. 400க்கு 160 னா 500க்கு எவ்வளவு? So standard quantity into standard price is equal to cross multiplication. 160 is the material cost. Okay, rupees in lakhs. 160 is for 400 means proportionately for 500 sales, what could be the material cost? That is the expected raw material cost. So 160 divided by 400 into 500 is equal to 200 is the expected material cost. Are you comfortable with respect to standard quantity into standard price? Yes, Jagan. Good. So now you got clarity. Standard quantity into standard price is equal to 200. Actual quantity into actual price given in this question 231. Actual quantity standard price is 210. So material cost variance is equal to 1 minus 2. 200 minus 231 is equal to 31 rupees adverse. Everything rupees in lakhs. In exam you have to write rupees 31 adverse. Same manner 1 minus 3. 200 minus 210 is equal to 10. Okay. 10 adverse. Similarly, 3 minus 2 is equal to 210 minus 231. Difference comes from as 21 adverse. Am I right? Rupees 21 adverse. So material cost variance 31, rupees 31 lakhs adverse. Material price variance 21 lakh adverse. Material usage variance 10 lakh adverse. Understood the material variance, my dears? எல்லாருக்கும் புரிஞ்சுதா? Are you comfortable? I have to go for labor. ஒரு calculator கொடுங்க. இதுல பவர் ஹவுஸ் ஓபன் பண்ணுங்க. Now, labor. With respect to labor, same manner I have to go for labor. Up to this stage, are you comfortable, my dears? Yeah, thank you, my dears. Thank you. Thank you, Jagan. Next, I have to go for labor. Actual horse into actual rate represent actual labor cost incurred. How much the actual labor cost incurred that is given in this question? 138 lakhs. Year 2's labor cost is equal to 138 lakhs. Next, actual horse into actual rate. With respect to actual horse into actual rate. When compared to year 1, there is a 15% increase in wage rate that is given in this question. Upper, when compared to expectation, actual got increased by 15%, 15%. Am I right? So, if we see here, this is actual rate, this is standard rate. When compared to standard, actual labor cost increased by 15%. Therefore, okay, 138 divided by 115% before increment comes to how much? Comes to 120 lakhs. So 120 lakhs, okay? Cancel, save cancel. Yeah. So 120 lakhs. Next we have to go for standard horse into standard rate. What about the standard horse into standard rate? Same manner. Currently for 400 sales, wages comes to 100. For 500, what the wages supposed to be? It's called what? Standard. So, wages for the current situation how much? Last year how much? 100 out of 400. 100 divided by 100 is the wages for 400 means for 500 how much? So with respect to standard labor hour represent, expected for actual is called standard. 400 க்கு 100 னா 500 க்கு எவ்வளவு? The proportion is called what? Standard. So kindly compute and tell me 100 divided by 400 into 500 comes to 125. Am I right? Kindly check it up. So 125 lakhs. Yeah, thank you, Gana. Yeah, 125 lakhs is a labor standard expected labor cost. So thank you. 1 minus 2 is equal to 125 minus 138 is equal to how much, Kanna? 13 lakhs of course. Am I right? Thank you. 13 lakhs adverse. 1 minus 3 is equal to 125 and 120. So 5 lakhs adverse. 3 minus 2 is equal to 120, 138. Upon 18 agana? 18 lakhs adverse. So are you comfortable? Now, shall I go to the next one? So, material over, labor over. Now we have to go for variable overhead. With respect to variable overhead, $5 lakhs favorable. Check it up. 5 lakhs favorable or adverse. 1 minus 3. Yeah, 1 minus 3, 125, 120. Yeah, 5 lakhs favorable. Yeah, thank you. 18 lakhs adverse, 5 lakhs favorable is equal to 13 lakhs adverse. Yeah, thank you, Jagan. Yes, correct. You are correct. Next, we can go for variable overhead. Actual variable overhead incurred for the current period comes to 48, that is given in this question. Actual horse into actual rate. When compared to standard rate, actual rate, there is no increase or decrease given in this question. If there is no increase or decrease, same 48 is applicable. Understood or not? Because material price got increased by 10%, labor got increased by how much? 15% was given in this question. But with respect to overhead, there is no change with respect to expected rate to actual rate. So if there is no change between expected rate to actual rate, actual horse only are going to multiply. Therefore, same 48, second column as well as third column. With respect to first column, expected overhead for actual production. So how much expected overhead for actual production? So if you see, with respect to overhead, 40 is the overhead for 400. 40 lakhs overhead for 400 lakhs means for 500 lakhs how much? Am I right? It comes to 50 lakhs. So 1 minus 2 is equal to 50, 48. Therefore, 2 lakhs favorable. 1 minus 3 is equal to 50, 48. So 2 lakhs favorable. 3 minus 2, 0. There is no difference in expenditure. Therefore, expenditure variance is equal to 0. Got it, my dears? The next one is fixed overhead variance. Actual fixed overhead, current year fixed overhead is called actual fixed overhead, 30 lakhs. Budgeted fixed overhead is the last year overhead, comes to what? 20 lakhs. Okay. Now, actual output into standard rate. How to identify? 20 lakhs is for 400, whereas current year 500, what could be the cost? So, we compute 20 divided by 400 into 500 comes to 25 is coming. Kindly check it up the calculation part also. Okay. This comes to 25. The expectation with respect to actual comes to 25. So 1 minus 2, 25 minus 30 is equal to 5 lakhs adverse. Next, 1 minus 3 is equal to 25 and 20. 1 minus 3. 25 and 25 lakhs favorable. Am I right? 3 minus 2 is equal to 20 minus 30. 10 lakhs adverse. 10 lakh adverse, 5 lakhs favorable, net to 5 lakhs adverse. Correct. So, got it, my dear? Fixed overhead variance. Next, if you see the speciality of this particular question, they are given previous year as well as current year P&L accounts. So, based on P&L account, nothing but based on financial information, we solved all the problem. If you see, in general, with respect to variance analysis, we needed quantitative data. Am I right? How much expected consumption of raw material, actual consumption of raw material is how much, expected labor cost is so much, actual labor cost is so much, expected budgeted sales is so much, actual sales is so much. All quantitative information we need to solve the problem. But speciality of this question, without having any quantitative information, by way of financial information, we solve the problem. That's the speciality. Got the clarity with respect to importance of this particular question? There is no quantitative info. Ellame financial data. Based on financial data compared to previous year to current year, we have prepared variance analysis. It's a peculiar problem. Hope you're enjoying the problem. Right? Then, last one is sales variance. Actual quantity into actual price is equal to actual sales. So what about the actual sales? Current year 540. Then when compared to, it's a budgeted price. Yeah. When compared to budgeted price, actual price got increased. How much percent? 8%. Am I right? So 540 divided by this after increasing 8%, 108%. Therefore, without increasing price means it's supposed to be 500 only. Budgeted quantity into budgeted price, it's nothing but previous year. So comes to 400. So 400, 540. Difference comes to 140. Favorable. In sales variance, negative means favorable, positive means adverse. Yeah. Favorable. 1 minus 3, 400, 500. 100 volume wise favorable. Price 500, 540. 40 is also all favorable. Understood? That is what we have segregated in the beginning. When compared to previous year 400 lakh sales, current year 500 lakhs because of the volume and 40 lakhs because of the price. So total comes to 400 previous year, whereas current year 540, different 140 is a favorable variance because sales got increased. Understood? Have you enjoyed the problem, Kanam? All are comfortable? Thank you. Such a beautiful problem. Based on the financial information, you have to compute all the variances. Now, shall I go to the next problem? Hope you enjoyed this question. Now, KPMG manufactures a product which is obtained basically from a series of mixing operation. The finished product is packaged in the empty made glass bottle. Companies made glass bottle and packed in attractive cartons. The company is organized into two independent divisions. That is, one for the manufacturing of end product and other for the manufacturing of glass bottle. The product manufacturing division can buy all the bottle requirement from the bottle manufacturing division. GM of the bottle manufacturing division has obtained the following quotation from the outside manufacturers for the supply of empty bottle. Number of empty bottle 8 lakhs units. Purchase value comes to rupees 15 lakhs. Then 15 lakhs. Accordingly, bottle manufacturing division for the manufacture of empty bottles holds to the following production cost. Number of empty bottle 8 lakhs. Total cost comes to 11 lakhs. So one is from outside market, another one is for cost of production. Yes. One is for purchase price and one is for cost of production. If I am going to make the product, if I am going to buy the product, how much? The production cost and sales value of the product marketed by the product manufacturing division are as under. Volume 8 lakhs quantity, total cost of the end product 60 lakhs, sale value comes to 95 lakhs. There has been a considerable discussion at the corporate level as to the use of the proper price for the transfer of empty bottle from the bottle manufacturing division to the product manufacturing division. This interest is high-ended because a significant portion of the divisional manager salary is in incentive bonus based on the profits center result. As a corporate management accounting responsible for the defining the proper transformation supply of empty bottles, bottle manufacturing divisions, production manufacturing divisions, you are required to show the profitability and fix the transfer price by using market price, and second one, share profit relative to the cost involved. Third one, cost plus 20% profit. The profitable portion should be furnished separately for the two division and the company as a whole under each method. Also discuss for overall company's point of view which method is advisable. Shall we try? This question is based on transfer pricing. I'll explain the question. Companies having two division. One is called bottle manufacturing division, another one is called end product division. Nothing but container division and content division. Out of these two division, their selling price, purchase price, all those things given in this question for two different quantity, 8 lakhs quantity as well as 15 lakhs. Yeah, 8 lakh quantity. Yeah, available for the 8 lakhs quantity. Based on the same, we have to fix the transfer price. We have to fix the transfer price. With respect to transfer price, one is based on shared profit method, another one is based on cost plus profit method. Market price method also, market price method. Between two, which one is preferable? The third one is, if I am going to add cost plus profit, how much the value? That is also you have to find. Out of which method is preferable, you have to identify. So this question is based on transfer pricing. Three methods they are asking. First one is market price method. Second one is shared profit method. Third one is cost plus profit method. Cost plus 20% profit they want to add. Out of three options, which option is preferable, that we have to identify. First, you have to fix the transfer price find the transfer price for each situation. Then, first one. Market price method we can solve. We are in transfer pricing. Based on market price, how to fix the transfer price. With respect to market price, we are having two division. One is empty bottle division. Empty bottle division's sales revenue comes to how much? 15 lakhs. Whereas empty bottle division's cost comes to empty bottle divisions 15 lakhs and 11 lakh is the cost. So how much the profit? Profit comes to 4 lakhs. End product division. End product division. With respect to product division, sales revenue for the product 95 lakhs. For that, cost comes to 60 lakhs. So 95 lakhs is a finished goods value. For that, how much the cost of production for the content? 60 lakhs. and purchase value of container empty bottle comes to 15 lakhs. Am I right? Selling price of the transferring division is equal to cost of the recipient division. So bottle selling price 15 lakhs mean that container cost of purchasing division comes to 15 lakhs. So how much of profit for this particular division? 95 lakhs minus 60 lakhs minus 15 lakh is equal to 20 lakhs. Therefore, total profit for the company as a whole comes to 24 lakhs. Both the division together contributing company's profit to the extent of 24 lakhs. Understood up to this stage? Any doubt in market price method? Two divisions are there. One is container division, another one is content division. Container division, sale value of the container division. Sale value of the container division comes to 15 lakhs. For that, how much the cost incurred to produce a product? 11 lakhs. Therefore, 4 lakhs is a profit for the container division. Whereas content division, the finished goods they are selling it for 95 lakhs. To produce the product, they are incurring 60 lakhs. And content division is purchasing container from the container division. One division, another division, they are transferring. If they are going to transfer it to market price of the container empty bottle comes to 15 lakhs. So sale value of the transferring division is equal to cost of the purchasing division. Therefore 95 lakhs the sale value for the content, 60 lakhs and 15 lakhs is the cost. Therefore net profit comes to 20 lakhs for the end product division, finished goods division. Therefore total profit, container division 4 lakhs, content division 20 lakhs, company as a whole earned 24 lakhs is a profit. Are you clear, my dears? Jagan Sankita எல்லாருக்கும் புரியுதுங்களா? Okay. Next, shall I go to the next one? Second one. What are the next requirement? Yeah, thank you for your response. We have to fix the transfer price here. So transfer price is equal to sale value how many lakhs? 15 lakhs. For how much quantity? 8 lakh bottles. Therefore, transfer price per unit is equal to 15 lakhs divided by 8 lakhs comes to 1.875 rupees per bottle, rupees per unit. Next. Next we can go for shared profit method. Instead of market price, if we go with shared profit method, what could be the impact? Shall we try? With respect to shared profit method, company as a whole going to get the revenue. Sales revenue of the company comes to 95 lakhs, we got it. Whereas cost, with respect to cost, content division, end product division's cost comes to 60 lakhs. Cost of production comes to 60 lakhs. Container division, empty bottle division's cost comes to how much? 11 lakhs. 11 lakhs. Therefore, company can get the profit of 95 lakhs minus 60 lakhs plus minus 11 lakh is equal to 24 lakhs. It's a company's profit. Now, company got the profit of 24 lakh. That profit, out of which we have to compute transfer price. You know, transfer price applicable only for which division? Transferring division alone. Which one is a transferring division? End product division is a transferring division. Therefore, transfer price is equal to cost plus share of profit, because it's a shared profit method. Cost of the end product comes to, cost of the empty bottle comes to 11 lakhs plus share of profit. Overall company's profit 24 lakhs. Am I right? Overall company's profit 24 lakhs. Total cost for the both division comes to 71 lakhs, whereas empty bottle division only 11 lakhs. So based on cost they invested, we are sharing the profit. Are you able to follow or not? Investment made by the end product 60 lakhs, investment made by the empty bottle 11 lakhs, out of which only company has, by way of contribution of both the divisions profit only, company has earned the profit on both the divisions effort only, company has earned the profit of 24 lakhs. Upon 24 lakhs, we have to apportion between the two different divisions. In what basis? Whatever the effort they made, 60:11 ratio we are apportioning. So 60 plus 11 is equal to 71 is the denominator, 11 is the numerator. So share of profit for the empty bottle comes to 11 out of 71. So 11 lakhs plus share of profit comes to how much now? 11 lakhs plus 3,71,831 is the profit. Am I right? That is equal to 14,71,831. 14,71,831 is for 8 lakhs quantity. Therefore, transfer price is equal to per unit price is equal to 1 rupee 83 paise per unit. Yeah, thank you, Jagan. 1471,831. Yeah, correct. But the Zoom class, somebody will compute and tell all those answers. Here I have to compute on my own. Thank you for your support. Yes, Krishna. In your system is in OBS software, please drag the screen into full screen and also move your face top right corner. Oh, how to do? Since my first time, I don't know how to operate also. Top right corner maathikanuma. I'll try, Krishna, just a minute. Where to operate, I don't know. Are you screen still went? I'll try. Is it okay now? I think top right corner face has come. Am I right? Is it okay, Krishna? Another one is at what? Please drag the screen into full screen. That's how full screen. Full screen. Same manner. I'll try. Talking about this, am I right? Is it correct? Anything I have to do now? That's all. I don't know what is correct or not, but tried it. Krishna Kumar, is it okay? Shall I proceed? Hope it is okay now. Correct, sir. Thank you so much, Kumar. All I'm comfortable only in Zoom. First time doing all those things. Thank you for your advice. Good. We'll go to next one then. So shared profit method over. Transfer price of the shared profit method comes to 1.83. What is the third requirement? Cost plus profit also they ask. Yeah. With respect to cost plus profit, cost plus profit is easy. Transfer price based on cost plus, they said 28% profit, am I right? 28% profit. Cost 11 lakhs plus 28% profit on cost. 20% profit on cost comes to 2,75,000. 13,75,000. So the transfer price comes to 13,75,000 total value. Divided by number of unit 8 lakhs quantity. Therefore, transfer price per unit is equal to 13,75,000 divided by 8 lakhs is equal to 1.71 per unit. So, if you prepare the profitability statement based on the same, statement of profit, sales revenue for the company 95 lakhs less cost of production of the product comes to 60 lakhs. Empty bottles cost, we got cost plus profit method 13,75,000. Right? So profit for is the end product division, right? Profit for the end product division comes to 95 lakhs minus 60 lakhs minus 13,75,000 is equal to 21,25,000. Kindly check it if the computation correct or not. 21,25,000. Same manner. The next division, empty bottle division, the profit, already we got it, 2,75,000, 28% on cost. $2,75,000. So, overall company's total profit is equal to 21 lakhs 25,000 plus 2 lakhs 75,000 is equal to 24 lakhs. Are you clear? Yes, Kanna, 21 lakh 25. Good. So, we'll have the answer summary for better verification, better understanding. Answer summary. We are having three options, right? Market price method, shared profit method, cost plus profit method. For empty bottle division, and the total is called company. Company's profit. Empty bottle divisions under market price method, how much the profit we got it? 4 lakh is the profit. Whereas end product division comes to 20 lakhs profit, total profit 24 lakhs. Am I right? Based on the previous one, I am giving the posting. Whereas shared profit method, empty bottle division, 3,71,831 is the profit. End product, how much profit? 20 lakhs 28,169. How come 20 lakhs 28,167 169? Proportionate profit you have to add. Am I right? Same manner, 60 lakhs. If you add totally how much? 71. Yeah, 71. So 24 lakhs is the profit for 71, whereas 60 proportionately. 24 lakh divided by 71 into 60. If you add that profit, you'll get how much? You get the profit of how much? 24 lakh divided by 71 into 60 comes to 20 lakh something. But I had 20 lakhs 28,167. It's a profit of the end product division. Same manner, cost plus profit, we got 2 lakh 75,000 for the end product, whereas empty bottle, whereas end product 21 lakh 25,000. Total profit, irrespective of the case, all the column we are having same 24 lakhs only. So the moral is what? Irrespective of the method, overall company's profit remains same. Just because of profit increase or decrease, transfer price got increase or decrease, company's profit will not get affected. Why? Profit of the one division is equal to cost for the next division. Therefore, or debit or credit nullified. So, irrespective of the method, company may going to get the same profit only. If you see which one is more preferable, if you go by way of market price method, empty bottle division method. With respect to empty bottle division, market price method will be preferable because here only they are getting more profit. Whereas end product division, if you go ask which method is preferable, they are getting high profit in 21 lakhs 25,000. Am I right? So if you see the preference wise, with respect to preference, empty bottle division may prefer market price method. Am I right? Whereas end product division may prefer the last method, cost plus profit method. Am I right or not? Because there only we are getting more profit. But irrespective of the method, company is going to get the same profit. Therefore, in this juncture, company no need to fix any fair transfer price at all. Now there is a conflict between empty bottle division and end product division. Even if the conflict, there is no need for the company to do any fixation of fair transfer price. In this juncture, the advisable transfer pricing is negotiated transfer price method, bargain, also called bargain method. What is negotiated method? Both the division can sit together because overall company's profit remains same. So whatever then, mutually they are going to get the conclusion that transfer price is preferable. That is called negotiated transfer pricing method. Are you comfortable, my dears? Any doubt in transfer pricing? Hope you enjoyed this question. All are happy? Jagan. Shall I go to the next one? Yeah. We'll go to the next problem. Any doubt, Kanna? Good. ABC Limited has two divisions, A and B, which manufactures bicycle. Division A produce bicycle frame and Division B assemble the rest of the bicycle on frame. There is a market for sub-assembly and the final product. So both the division has their own marketability. Each division has been treated as a profit center. The transfer price has been set at the long run average market price. Division A's maximum capacity is 1000 per month and the sale of intermediate products are now 800 units. The following data are available to each division. Estimated selling price of the final product 3000 rupees per unit. Long run average market price of sub-assembly 2000 unit per unit. Incremental cost of completing sub-assembly in division B comes to 1500 unit. Incremental cost of division A comes to 1200 units. Requirement: maximum quantity to be transferred. What would be the minimum transfer price? What would be the fair transfer price if the profit of the company distributed on equal between the divisions? Find fair transfer price if manager of division B is arguing that there is no equity on equal distribution of company's profit. It is justice only if the profit is shared based on efforts or investment made by the division. Next requirement: find fair transfer price if the profit is shared between value added by the division, assuming out of 1200 incremental cost of division A, 20% is raw material cost. Next requirement: if outside market increase to 1000 unit, should division A continue to transfer 200 units of division B or sell the entire production to outside market? So totally 6 requirement. This question is based on transfer pricing. Kindly go through the question quickly. Start பண்ணலாமா? answer part. Particulars, division A and division B. Division A is the frame division. Division B is the bicycle division. Division A is called intermediate product. Division B is a fully finished product. You know, in automobile industries and all, they will sell the intermediate product alone separately. Like tire they will sell, frame they will sell, and after assembly the product will come. Like car they will sell, bicycle they will sell. So one is called intermediate product, division A. Another one is called fully finished assembled product, is called division B. This is a bicycle company. Frame division, frame also having market value, whereas fully finished product called bicycle is also having market value. Now, available data in this question. Market value, nothing but selling price of the frame alone. The parts alone they will sell means 2,000 rupees is selling price, whereas cycle as a whole 3,000 rupees. How much the cost, the incremental cost, the cost to produce the product of the frame, they have to incur 1,200 rupees, whereas for the purpose of assembly to convert into bicycle they have to incur 1,500 rupees, the cost of the division B. And you know, frame division's cost is the cost of the bicycle also, right? You know, output of the one product going to become input of the next product process. So frame, if it comes into the process, frame cost as assembly cost equal to total cost for the bicycle. Are you able to follow? Therefore, if you see profit, the company is going to sell the frame alone, then profit for the division comes to 800 rupees. Company going to convert the frame into bicycle, sale value 3,000, whereas cost comes to 1,500 plus 1,200, for 2,700. Therefore, profit for the company 300. You know, in general, automobile industry, if they are going to sell the part will be costly, whereas fully finished profit is comparatively vast, not that much. Even if you say take the mobile cost, how much they are going to get the profit, mobile by way of selling the mobile. But if you are going to what, ask the parts alone separately, battery alone, screen alone, clear, part by part you are going to buy means, that's the what, a huge profit they will take, am I right or not? Sometimes we will decide, instead of what, repairing the mobile, we can purchase a new mobile itself. So same manner for the automobile industry. Fully finished product, they are getting profit of 300. If they are going to sell the parts alone, they are getting profit of 300. This is what the story in this question. Hope you understood the story. Are you clear, my dears? எல்லாருக்கும் question புரிஞ்சுதுங்களா? Now, we'll go by requirement. First question. Maximum quantity to be transferred. How much the maximum quantity we have to transfer? Transfer means what? How much quantity we have to frame division has to transfer to bicycle division. Where we are going to get more profit, that only company prefer. Therefore, obviously company prefer to sell maximum to that extent of frame, so that they will get more profit. Therefore, capacity of production. What is the maximum capacity to produce a product? Division A, maximum capacity 1,000 quantity they can produce. I can produce 1,000 quantity. I want to utilize maximum profit of 800. Therefore, what about the for division A? Frame division's demand is how much? That we have to identify. How much the demand for the division A? and the sale of intermediate product now 800. 800 is the demand is there. So I can produce 1000 quantity, out of which 800 is the demand is there. Intermediate product represent what? The frame. Am I right? So all the demand I want to satisfy, I want to sell. Therefore, out of 1800 quantity, I am going to sell it as a frame itself. Balance to be transferred to next division comes to 200 units, 200 frames. This is the maximum quantity we can transfer because we can get maximum profit out of intermediate division itself. It's the first requirement. Now we can go for second requirement. What would be the minimum transfer price? You know the rule for the transfer price. Minimum transfer price should be, what would be the minimum transfer price? Any guess? The company is going to sell the product, transfer the product. Minimum transfer price should be what? What is the answer, my dears? Kindly participate. Minimum எவ்வளவு fix பண்ணலாம்? Kindly respond, all of you. Shankita, Krishna Kumar, how much the minimum transfer price we can fix? Jaganji. So, minimum transfer price should be whatever the cost we incurred is the minimum transfer price. We should not incur any loss. Therefore, minimum transfer price is equal to our variable cost or cost of production. Clear? Therefore, how much the cost incurred to produce the product? That we got it 1200. Am I right? Division A's cost comes to 1200. Therefore, minimum transfer price supposed to be rupees 1200 rupees. Yes, Kanna. Understood? Shall I go to the next requirement? Now we can go for third requirement. What would be the fair transfer price if profit of the company distributed on equally between the divisions? Profit has been transferred equally between the divisions. So fair transfer price, our fair transfer price is equal to variable cost plus share of profit. Variable cost 1200 plus the share of profit. If I am going to sell the product, how much the profit will be earned by the company? Okay. 300 rupees the profit. That we have to, the 300 rupees of profit out of the effort of both the division, frame division as well as bicycle division. Therefore, Therefore, 300 into 1 by 2. Share of profit, we are going to share equally. I think 50% of the share we are going to take. 150. So, 1350 rupees is the fair transfer price if they are going to share equally. Got the clarity? Are you comfortable, my dears? Next. You can go for the fourth requirement. If outside market, find fair transfer price if manager of the division B is arguing that there is no equity on equal distribution of company's profit. Because previous item they said one, equally profit should be distributed. So the next requirement, they didn't want to share the profit equally. So it is justice only if the profit is shared based on effort investment made by the division. how much effort made by the division, accordingly you have to share. That is what the next argument. So in that juncture, what could be the fair transfer price? So fair transfer price is equal to variable cost plus share of profit. Variable cost 1200, profit of the company 300. That we have to apportion based on the effort made by the company, effort made by the division. What about the effort? Nothing but investment. Investment of the frame division comes to 1200. Bicycle division comes to 1500. Upper total investment 2700 rupees they invested totally. Am I right? So the 300 is a profit out of 2700 investment, whereas frame division has invested only 1200. You have to apportion the ratio of 12:15 ratio. Got it or not? Based on the investment, nothing but based on the cost invested. Therefore, divided by 2700 into 1200. In that ratio, share of profit of the transferring division. Are you comfortable or not? 300 is a profit out of 1200 and 1500 is effort. Therefore, totally 2700 is a total investment. Out of it, 1200 only investment made by the transferring division. What could be the share of profit? Comes to how much, my dears? So 1200 plus 133. Check it up. 133 comes to 1333 is a fair transfer price based on investment made by the each division. Hope am I correct? Am I right? 1333. Yeah, thank you, Sankita. Now we can go for the fifth one. Fifth one. Yes, Jagan, 1333. Find the fair transfer price if profit is shared based on value added by the division. Assuming out of 1200, incremental cost of the division A is 20%. A is 20% is the raw material cost. Again, fair transfer price in different manner. Fair transfer price is equal to variable cost plus share of profit. Variable cost 1200 plus share of profit. The share of profit is based on what? Value added by the division. So, value addition you have to identify. How to identify? With respect to value addition, particulars, division A, division B. How much the cost incurred by the division A and division B? 1200 and 1500. Total cost minus raw material cost is equal to value addition. Other than raw material cost is the value addition to the company only. Okay. So how much the raw material cost they are given? 20%. 20% on 1200 is equal to 240. Here assembly division there is no purchase, everything assembly only, therefore everything is called validation. There is no raw material for assembly division. Therefore validation comes to 1200 minus 240 is equal to 960, whereas division B 1500. So we have to apportion the profit, company's profit, in the ratio of 960 and 1500 in that ratio. How much the company's profit? Share of profit based on 960 into 1500. Share of profit is 300. Total profit of the company 300. If I am going to apportion in the ratio of 96 into 150 ratio, comes to how much? 117 is the share of profit. Am I right or not? 300 rupees you have to apportion in the ratio of value addition. So 117 is the value addition. Hope you understood 117 value addition. So fair transfer price is equal to 1200 plus 117. 1317 is the fair transfer price based on value added. Understood, my dears? Good, Kanna. Next. Next requirement, I think 6th. If outside market price increase, should division A continue to transfer 200 units to division B or sell entire product to outside market? So based on the first requirement only, the last one. Am I right? We said currently demand is 800. Where current capacity to produce comes to 1000 but demand is 800, therefore 200 quantity we can transfer. Why? Because intermediate sales we are having more profit. Now the demand got increased to the extent of 1000 itself, then capacity also 1000, demand is also 1000. How much we can transfer? So we may not be able to transfer all the quantity, we have to sell it to outside market itself. Got it or not? Sixth requirement. If demand of division A is increased to 1000 units, then no transfer at all. All the product we are going to sell it in the intermediate market itself. Got it, my dears? Any doubt? Shall I go to the next one? One more requirement is also there. Suppose in the above situation, if the top management want to insist division A should transfer the product to next division, what could be the suitable transfer price? Am I right? What could be the suitable transfer price? Division A is having market. Am I right? They are profitable also. In this circumstance, company as a whole insisting, no, don't transfer the product to outsiders. We have to transfer to internal division only. In this juncture, what could be the suitable transfer price? That is what the question. What could be the suitable transfer price? Kindly respond. What the answer, my dears? The answer is, first you can try now. Jagan, what the answer? Any idea? Division A is having the market. Demand is there. But for the purpose of overall benefit of the company is insisting, don't transfer to intermediate. You have to don't transfer to what? Outside market. You have to transfer all the product to your next division only. In this juncture, what is preferable? What price you have to fix? Sankita. The answer is market price. Cost plus opportunity cost. Yeah, that ends with what? Market price only. They are having the profit in the local market, same price will come. So better to transfer at market price itself. Then only, without affecting division A, we can be in the position to transfer the product to division B. Are you comfortable, my dears? Got it? Good. Shall we go to the next problem? Any doubt? Want any small 5 minutes break or shall we continue? Jagan, Sankita, Krishna. Want any 5 minutes break or shall we continue? Want any 5 minutes break? Kindly respond. Yeah, dear students, kindly respond. Break, sir. Okay. 5 minutes sufficient? Okay. Small break. 5 minutes. Okay. Come back quickly. Okay. Are you ready, Kanna? Yeah. Dear students, shall we start? Are you ready? Sangeeta ready, Amma? Jagan? Kindly respond, my dears. Am I visible? Am I audible? Shall we start? Yes, Jagan. Welcome. Sangeeta Vandacha, Krishna. Okay, we'll start. A large company is organized into several manufacturing divisions. The policy of the company is to allow divisional manager to choose their source of supply and when buying from or selling to sister division to negotiate the price just as they will for outside purchase or sales. Division X buy all the requirement of its main raw material R from division Y. The full manufacturing cost of R for division Y is 88 rupees per kg at normal volume. Till recently, division Y was willing to supply R to division X at transfer price of 80 rupees per kg. The incremental cost of R for division Y is rupees 76 per kg. Since the division Y is now operating its full capacity, it is unable to meet the outside customers' demand for R at the market price of rupees 100 per kg. Division Y therefore threatened to cut off supplies to division X unless the latter agreed to pay the market price for R. Division X is resetting the budget because its budget based on the consumption of 1 lakh kg per month at a price of rupees 80 per kg is expected to yield a profit of 25 lakhs per month, and so a price increase to 100 per kg will bring the division X close to break-even point. Division X has even found outside source for a substitute material, a price of rupees 95 per kg. Although the substitute material is slightly different from R, it would meet the need of division X. Alternatively, division X is probably prepared to pay division Y even the manufacturing cost of 88 per kg. Requirement: using each of the transfer price of 80 rupees, 88 rupees, 95 rupees and 100 rupees show with supporting calculation the final result as projected by the manager of division X, manager of division Y and the company. Second requirement: comment on the effort of each transfer price on the performance of the manager of the division X and the division Y. If you were to make a decision in the matter without regret to the view of the individual division's manager, where should division X obtain its material from and what price? This question is also based on transfer pricing. First one, the transfer price is 80 rupees. You have to prepare if the transfer price 80 rupees, 88 rupees, 95 rupees and 100 rupees. The first requirement, if transfer price is equal to 80 rupees. What could be the impact that we are going to see now? We are having two division, yeah? Division X, division Y, and company as a whole. In case of 80 rupees the transfer price, how much the profit that is given in this question? 80 rupees transfer price yield a profit of rupees 25 lakhs per month. So current profit for division X is equal to 25 lakhs. Division Y, sales, how much quantity available? Sales quantity comes to 1 lakh kgs. Therefore, sales 1 lakh kgs into 80 rupees is equal to 80 lakhs. How much the cost or variable cost or cost of production for that product? Any info for cost of production? Incremental cost for Y is 76 rupees. So per unit cost comes to 76. 76 into 1 lakh is equal to 76 lakh is the cost. So profit for the division Y comes to 4 lakh is the profit. Company's profit is equal to division X profit and division Y's profit. Total 25 lakhs plus 4 lakh is equal to profit of the whole division comes to 29 lakhs. Then the next one, if transfer price is equal to 88, am I right? If it is 88, what would be the impact? You know, Y is transferring the product to X. Current profit 25 lakhs. When 25 lakhs, if they transfer the product at 80 rupees, yeah. Current profit 25 lakhs. Whereas if they increase the transfer price instead of 80 to 88, they increase 8 rupees extra. Am I right? That to number of unit 1 lakh. Therefore, incremental transfer price additional 8 lakhs when compared to present situation to next situation. Therefore, for the revised profit of the division X, originally 25 lakhs if transfer price is equal to 8 lakhs. If they increase the price to 88 lakhs, extra 8 lakhs is the cost of the recipient division. Therefore, revised profit comes to 25 lakhs minus 8 lakhs is equal to 17 lakhs is the profit of the division X. Whereas division Y, sales revenue 1 lakh into 80 become 88. Up 88 lakh is the sales revenue. Variable cost remains same. Because of increase in price, transfer price, variable cost will not going to get affected. Variable cost remains same, 76 lakhs only. Therefore, profit of the transfer division comes to 88 lakhs minus 76 lakh is equal to profit. 12 lakh is equal to profit. Therefore, overall company's profit comes to first division 17 lakhs, second division 12 lakhs, total comes to 29 lakh is the profit for the company as a whole. Next. Similarly, if transfer price is equal to how much now? 95. Same manner. 95 rupees the transfer price means current profit 25 lakhs, whereas incremental transfer price 80 become 95. Additionally 15 lakhs price got increased. Therefore, incremental transfer price is the cost for the recipient division, 15 lakhs incremental cost. Therefore, revised profit comes to 10 lakh is the profit. Division Y, sales revenue 95 into 1 lakh quantity is equal to 95 lakhs. Variable cost is 76 lakhs. It remains same. Therefore, revised profit comes to 95 minus 76 is equal to 19 lakhs upon. Yeah, 19 lakhs for the company, division Y. Overall company's profit comes to 10 lakhs plus 19 lakh is equal to 29 lakhs is the overall profit for the company. Next they said what? If transfer price is equal to 100, am I right? The transfer price is 100 means current profit 25 lakhs. If in case of 8 lakhs is the transfer price, 80 rupees the transfer price, now it become 100 rupees. Therefore, additional 20 rupees got increased. Therefore, incremental transfer price 20 into 1 lakh is equal to 20 lakhs. Therefore, revised profit comes to 5 lakhs for the division X. Division Y, sales revenue 100 into 1 lakh. So, 100 lakhs. Variable cost remains same, 76 lakhs. So, balance is equal to profit. 24 lakh is the profit. Overall company's profit 5 lakhs plus 24 lakh is equal to 29 lakh is the profit for the overall company. Got it or not? Now, with respect to first one is over. 80 rupees, 88 rupees, 95 rupees, 100 rupees. Division X, division Y as well as company over. Next, comment. Yeah. Next one is comment the effect of each of the transfer price. What about the comment? Because of the transfer price, what could be the impact? That is what the question. Am I right? With respect to comment, even each and every transfer price, rather irrespective of the transfer price, companies overall profit remain same. Why? Incremental transfer price of the transfer price of the transferring division is equal to incremental cost of the recipient division. Therefore, company's total profit remains same. It won't get affected at all. Or debit or credit nullified. Therefore, because of increase or decrease in transfer price, nothing is going to happen. Then, third one, if you were to make a decision in the matter without regard to the view of the individual divisions manager, where should the division X obtain the material at what price? Clear? In that circumstance, they said they are having the opportunity to sell the intermediate division's product at 100 rupees in the outside market. Am I right? I think 100 rupees only. Substitutional raw material they will get at 95 rupees. Outside how much we can sell? Yeah. Outside customers demand for our 100 rupees. The sense what? Raw material we can sell to outside it has 100 rupees. Substitutional material we can get it from outside market 95 rupees. Therefore, which one is preferable for the overall company's point of view? Division X, Division Y and the company. Now we can consider each division as a profit center. They can sell the product to outside market. In this juncture, Division X, currently how much the profit they get? 25 lakhs up, na? Yeah. They get the profit of here sales revenue. If you see, 95 is the outside market, right? 95 lakhs we can get it. Whereas variable cost comes to outside market 100 lakhs, right? Division Y 100 lakhs, no? Yeah. Yeah, 100 lakhs. 100 rupees. So here, if I am going to sell it to outside market, I can get 100 lakhs. So that how much the profit I can get? 24 lakhs I can get the profit. Whereas current profit for the division X is how much? 25 lakhs. That current profit is based on 80 rupees at transfer price. Now, substitutional material available at 95 rupees. Am I right? 95 rupees is available. Therefore, incremental price comes to how much? Incremental price from the outside market comes to 80, 95, 15. 15 lakh is the incremental cost, incremental price. Therefore, revised profit comes to 10 lakh is the revised profit. So, overall company's profit comes to how much? 10 lakhs plus 24 lakh is equal to 34 lakh is the revised profit of the company. Am I right? So, which one is preferable? Sell the raw material Y to outside market at 100 rupees and buy the substitutional material at 95 rupees. Buy the raw material at 95 rupees, sell our material at 100 rupees. That option is preferable. So that overall profit of the company will get increase. Instead of 29 lakhs profit, company can get overall profit of 34 lakhs. All of you understood, my dears? Any doubt? எல்லாருக்கும் புரிஞ்சுதா? Thank you, Jagan, for your response. Sangeeta புரிஞ்சுதாமா? Krishna, Hariharan, Gauri. Shall I go to the next problem? Yeah. Next question. Using capital employed, compute the economic value added EVA with the help of XYZ Limited provides you the following financial information as at 31st March 2018. Rupees in lakhs. Share capital 981.46 lakhs. Reserves and surplus 1,313.62 lakhs. Long-term debt 144.44 lakhs. Trade payables 20.38 lakhs. Additional information provided as follows. Profit before interest and tax comes to 2,202.84 lakhs. Interest paid is 13.48 lakhs. Cost of equity 12.42%. Cost of debt after adjusting tax comes to 6.53%. Required to calculate economic value added if tax rate is 30%. Can we go through the question quickly? Now, we'll go for the answer part. EVA calculation. Economic value added is equal to net operating profit after tax minus capital employed into KO, weighted average cost of capital, overall cost of capital. Net operating profit after tax minus capital employed into KO. Working note for capital employed. With respect to capital employed, equity share capital 981.46 lakhs. Reserves and surplus 1,313.62 lakhs. 1,313.62 lakhs. Then long-term debt 144.44 lakhs. This is what the total capital, that is called capital employed. Total capital employed comes to how much? 2,439.52 lakhs. Everything rupees in lakhs. Can you check it up the total? This is what the total capital employed. So capital employed 2,439.52 lakhs. Everything can be considered as rupees in lakhs into WACC, weighted average cost of capital. What about the weighted average cost of capital? Cost of debt fund is available or not? Cost of equity 12.42. Cost of debt after adjusting tax comes to 6.53. So, with respect to weighted average cost of capital, working note with respect to weighted average cost of capital, source of fund cost, weightage and KO percentage. With respect to source of fund, equity share capital, reserves and surplus, long-term loan. Equity share capital we are having 981.46, reserves and surplus 1313.62, long-term loan 144.44. Since the weightage divided by total of 2439.52 lakhs, here also 2439.52 lakhs divided by 2439.52 lakhs. Individual value of the shares, reserves and surplus as well as long term divided by total is equal to weightage. Cost of equity available 12.42%. Same thing applicable for reserves and surplus also. Reserves and surplus form part of shareholders fund, same 12.42%. Whereas debt fund after adjusting tax given 6.53. Otherwise you have to do the tax adjustment. So you have to multiply 12.42 into 981.46 divided by 2439.52. Similarly, 12.42 into 1313.62 divided by 2439.52. Similarly, 6.53 right, into 144.44 into 2439.52. If you make a total, you can get weighted average cost of capital. Can you please compute weighted average cost of capital? Multiply panungo. So answer for the weighted average cost of capital. $12.07. Check it up now. Is that 12.07 is correct? That's the weighted average cost of capital. Capital employed into 12.07. Net profit after tax. Clear? With respect to net profit after tax, next working. Available data, profit before interest and tax comes to 2202.84 lakhs. PBIT, earnings before interest and tax or profit before interest and tax comes to 2202.84 lakhs. Therefore, you have to reduce interest and reduce tax so that we can get profit after tax. Any interest element is there? How much the interest element? 13.48 agana. So 13.48. So comes to how much now? 2202.84 minus 13.48. Balance is equal to 2189.36. How much percent tax? 30% tax. Yeah. 30% tax comes to 656.81 is the tax. Am I right? So if you subtract everything, 2202.84 minus 13.48 minus 656.81 is equal to how much? 1532.552 upon 1532.552. Okay. All of you check it up, my dears. Is it correct now? Yeah. So 1532.55 is a net profit. So apply the same 1532.55. So what are the net answer now? %12.07%. What are the net answer now? 1000. Kindly check it out the total. 236 we can have it, right? Is it right? Rounding off to 1236. Kindly check it out the total alone is correct or not. Everything rupees in lakhs. Is it right? Check it out, my dears. Okay. Shall I go to the next problem? Hope the computation is correct. Kindly check it up. Shall I go to the next problem, ideas? Jagan. Yeah. Next problem. AKG Limited has 3 autonomous divisions. The divisions are evaluated on the basis of ROI. With years and bonus given to the divisional managers who have the highest ROI. Operating result of Division 2 for the last year are given below. Sales 2 crores 10 lakhs. Variable expenses how much? 1 crore 26 lakhs it seems. Balance is equal to contribution margin 84 lakhs. Fixed expenses 67 lakh 20,000. Net operating income 16 lakh 80,000. Divisional operating asset comes to 52 lakh 50,000. The company's overall return on assets for the last year was 18%, considering all the divisions. Division 2 has an opportunity to add a new product line that would require an investment of rupees 30 lakhs. Other details of new product line are as follows. Sales 90 lakhs per annum. Variable expenses 65% of sales. Fixed expenses 25 lakh 20,000 per annum. Life cycle on the product line is 5 years. Though the division 2 is performing well, but many a time a customers complain that they had to wait for long after placing an order. The company is interested in cutting the amount of time between when the customer places an order and when the customer is completed. When the order is completed. For the last year, the following data were reported in respect of division 2. Inspection time 0.5 days per batch. Processing time 2.8 day per batch. Waiting time 16 days per batch. Queuing time 4 days per batch. Move time comes to 0.7 days per batch. In addition to financial performance measure, the company wishes to introduce a varieties of non-financial performance measure. The company has set segregative target in both the sales growth and ROI for the company's coming year. The company's strategy for achieving these goals include a campaign aimed at building brand recognition, customer retention, improving at product quality, on-time delivery to the customer, expansion of eco-friendly product line, and the introduction of limited edition items. Required. Calculate the last year ROIs of Division 2. Discuss whether the manager of the Division 2 would accept or reject the new product line if he takes his decision based solely on divisional ROI. Third one, advise how residual income approach can be used as a alternative financial measures for evaluation of managerial performance in the best interest of the company. Calculate manufacturing cycle efficiency and interpret the results. State what percentage of the production time is spent in non-value added activity. And last one, calculate the delivery of cycle time. Second part of the question, calculate the new MCE, manufacturing cycle efficiency. If by using lean production, all queue time can be eliminated based on the above information, and using strategy map tablet to objectives and 2 measures for each perspective across the 4 dimensions of the balance scorecard in the following pro forma. What are all the perspective, strategic object and measures? That's all. Can we go through the question quickly? Shall we start, my dears? Yes, Jagan, yes. I will share the documents to you, sure. In the end of the session itself, I send the Word document in our Powerhouse Super 30 group itself. We held up with installing the software itself. We held up there itself. That's why. Got the questions, my dears? Now, thanks to Mr. Tarun Jagadish sir, who has helped me a lot for installing all the software, other things and all. The Super 30 is the brainchild began Tarun Jagadish sir only. Yeah. First requirement. Calculate last year return on investment of division 2. Shall we start? Return on investment of division 2. I'll write the answer here itself. You know, return on investment is equal to profit divided by investment into 100. For division 2's profit, how much last year? This chapter is based on performance evaluation. So, profit comes to 16 lakh 80,000. Investment comes to 52 lakhs 50,000. So profit 16 lakh 80,000 out of investment of 52 lakhs 50,000 into 100. How much the percentage of profit, my dears? Return on investment comes to 32%. Am I right? Answer for the first one is 32%. Next. Second requirement. Discuss whether the manager of the division 2 would accept or reject the new product line if he takes his decision solely on divisional ROI. But division 2, whether it can accept or not, based on ROI. We have to identify ROI. How much the sales revenue available? $90 lakhs. Variable cost out of which New product line, whether you have to accept or not. New product lines sales revenue comes to 90 lakhs less variable cost is equal to contribution. Variable cost, how much percent we saw? 65%. Remaining 35% is equal to contribution. So contribution remaining 35% is equal to 31,50,000. 31,50,000 less fixed cost is equal to profit. How much the fixed cost for the new product line? 25,20,000. So profit comes to how much? 6,30,000 is a profit. To get 6,30,000 profit, new product line, how much you have to invest? Investment of 30 lakhs. So profit 6,30,000, investment 30 lakhs into 100 is equal to return on investment. How much return on investment? 6,30,000 divided by 30 lakhs comes to 21%. Am I right? So based on return on investment, whether you can accept or not, company is having return on investment of 32 lakhs, whereas new product line having only 21 lakhs. So therefore, based on return on investment, not accepted or not advisable. Not advisable to accept the project. Got it, my dears? Because currently they are getting 32%, but new product line is giving only 21%. Therefore, not accepted. Are you comfortable? All of you? Next. Advice. How residual, so based on return on investment, it is not acceptable. Next one they are asking, advice, how residual income approach can be used. So, we are going for residual income based approach. Based on residual income, we can accept or not. With respect to residual income, profit we got, new product line profit comes to 6,30,000. Am I right? Less, we have invested 30 lakhs. Investment into cost of capital. Investment multiplied with the cost of capital. How much the cost of capital given? Cost of capital comes to 18%. Am I right? Considering all, 18% is a return. So, investment 30 lakhs. Yeah, 30 lakhs into 18% is equal to 5,40,000. So, profit less investment into cost of capital, balance is called residual income. So 6,30,000 minus 5,40,000 is equal to remaining 9 lakhs. So over and above the cost of capital, we are getting profit of 90 lakhs. We are getting profit of 90 lakhs. So based on residual income, whether you can accept or not, yes, it's profitable, we can accept. So advice, how residual income approach can be used as an alternative financial measure for evaluating the managerial performance in the best result of the company. So for the benefit of the company, even though the percentage is lesser than company's percentage, company currently getting 32%, new project is giving only 21%, even then, because incremental profit is there for the company to the extent of 90,000 rupees, we can accept. understand the importance of the residual income approach. The next one is what? Calculate is the next requirement. Am I right? Calculate manufacturing cycle efficiency. You have to compute manufacturing cycle efficiency. The next concept is called manufacturing cycle efficiency, also called process cycle efficiency. Manufacturing cycle efficiency is also called process cycle efficiency. Formula for process cycle efficiency is how much the processing time divided by total time into 100. Nothing but total time taken is a denominator, effective time is a numerator, into 100 is equal to efficiency. So percentage of efficiency how to compute. Now, time detail available in this question. Processing time 2.8 days. Effective time to produce the product comes to 2.8 days. Whereas total time given in this question 0.5 plus 2.8 plus 16 plus 4 plus what is that called? 0.7, 4.0 and 0.7. Total comes to how much? Add everything total. 0.5 plus 2.8 plus 16 plus 4 plus 0.7. Am I right? Total comes to 24. Kindly check it up. So out of total time 24, nothing but 24 days, 2.8 only processing time. Therefore, what are the percentage? Percentage comes to 11.67 percentage. Efficiency percentage comes to 11.67. Got it or not? So 11.67 represent what? Value addition. This is the value addition by the company. 11.6% only value addition to the company. So value added activity just only 11.67 percentage based on manufacturing or process cycle efficiency. 24 நாள்ல 2.8 days only productive ஆன time இருக்கு. Other things non-productive time. Therefore 11.67% only manufacturing cycle efficiency. That's the value addition. State what percentage of production time is spent in non-valid activity. What is non-valid activity? 100 minus value added activity is equal to non-valid activity. Therefore, if you subtract 100 minus 11.67, balance equal to 88.33 percentage. It's a huge number, right? 88.33 percentage is a non-value added activity. Next. What is the next one? The next requirement. Calculate delivery cycle time. Delivery cycle time is how much? The total time is called delivery cycle time. 24 days is a delivery cycle time. The total time taken is a entire cycle time 24 days. Next, they are given based on balance scorecard. Am I right? You know, in balance scorecard, what are all the perspectives are there? 4 different perspectives are there. Customer perspective, internal business perspective, innovative perspective, and financial perspective. So we have to identify what about the strategic objective and what measure you have to take. Am I right? That comes under which perspective? Strategic objective that is given in this question itself. by way of question we can what are the strategic measures? Yeah. என்ன சொல்லியிருக்காங்க? ஃபர்ஸ்ட் building brand. Building brand comes under what type of perspective? Comes under customer's perspective. What next? Campaigning is also there. Am I right? Next, recognition, customers retention, improving product quality, on-time delivery, then expansion of eco-friendly product line, introduction of limited entry editions. இவ்வளோ aspects இருக்கு. Now, everything comes under what type of prospective first you have to identify. Campaigning, building the brand, the recognition, all those things and all comes under one. Customer retention, these are all comes under one. Customer perspective. We are going to satisfy the customer. How to measure that one, whether we had the customer satisfaction or not, how to measure by way of how many customers who are recognizing our brand image or logo. How many customers are coming back again, repeated customers. Based on that, we can do the measurement. Listen here, my dears. Here, 3 requirements are there. Strategic object, which is given in this question. That strategy object comes under what type of perspective? Now we got one is customer perspective. How to measure whether it is effectively implemented or not. Customer perspective means repeaters customers are coming or not. Based on that, we can identify customer's perspective. I spend money for logo, brand image. How many of them recognize my logo? By way of number of customers recognize my logo, I can identify the customer perspectives amount I have invested. Clear? Next one. Improvement in product quality. I am improving the product quality. That comes under what? Even on-time delivery. On-time delivery to the customer. That's and all comes under internal business perspective. Okay? It helps us to what? Build our internal business properly. Internal business perspective. How to measure whether improved quality is available or not, on-time delivery is there or not. So, quality improvement is there, mean what is the percentage of defect? By way of percentage of defect you can identify. By way of number of percentage of order, increase in order, that we can identify. Clear? So, how many times they order, whether order size has been increased or not, defect got reduced or not. Based on that, we can be in the question identify this particular internal business perspective. Next, third one. Expansion of eco-friendly product line. Introduction to limited entry edition item. This and all comes under what? Innovative manner they are doing. Therefore, those 2 things come under what? Innovative perspective. How we have to measure the innovative perspective? How many eco-friendly product they introduce? Number of product. How many limited edition item they have introduced? Based on that, we can identify these are the measurement criteria. Then another one is financial perspective. Here there is no information with respect to financial perspective, but previously we saw return on investment. How much the growth rate happened? Return on investment happened. Based on return on investment, we can identify financial perspective. So what is the percentage of increase in return on investment is the measurement criteria. How much the turnover got increased? That's the measurement criteria for return on investments. So, understood, my dears? Any doubt, my dears? All are happy? Sangeeta madam, Jagade, Jagan, Krishna available or not? Gauri available or not? So, we have learned market size and market share variance. Then, without giving quantitative information, we did variance analysis. Material variance, labor variance, variable overhead variance, fixed overhead variance, including sales variance. But there is no quantitative information at all. By way of financial information itself, we derived all the variances. Next, transfer pricing, markets based on shared profit method, based on market value method, how to fix the transfer price is. Then, manufacturing cycle efficiency we learned, return on investment, ROI, economic value added, EVA, and residual income, all those things we have learned. Am I right? Weighted average cost of capital, in that what is form part of economic value added. Hope another one more transfer pricing problem also. Am I right? Various issues based on transfer pricing also you have learned. Hope you enjoyed today's session. Happy with today's session? Useful for your better preparation. So clearing SPOM paper is comparatively easy only. Every question they will convert into what? MCQ. So then even after putting the answer, you can verify whether answer is coming in the MCQ part or not. Always remember, this particular costing paper, you have to score 50 marks because it is not form part of Group A or Group B consolidated paper. Otherwise, 40 mark is sufficient. Another paper, if you are going to get 60 mark, offset by way of set off and carry forward, average 50% is sufficient. But it's an individual paper you have to clear in the SPOM. It's an online paper, online examination. First, ICI, whatever the video lecture they are given, that you have to complete. Minimum 80% is supposed to complete. Thereafter only you are eligible to write the main examination. This particular SPOM examination. And after writing the MCQs exam, online examination, immediately result will come so that you can get result of whether pass or fail. Minimum 50 marks is supposed to get. So that's a little difficult one. Right? Instead of 40, minimum 50 itself you have to get. And there is no restriction for writing number of time examination also this particular SPOM. But main examination in group 2, you can write only based on after clearing this particular costing paper. Nothing but strategic cost and performance management paper. So you have to clear this, then only you are eligible to write the main examination. And even though it's MCQ, most of the questions based on practical questions and a new management theory questions also there. So go through the study material properly. It's a combination of all past exam questions also they are converting into MCQs. Therefore, you should be strong in transfer pricing. You should be strong in cost, volume, profit, CVP analysis. Tomorrow we are going to discuss CVP analysis questions also. Clear? Activity-based costing is important. Standard costing is important. Budgetary control is important. So all the topics are important. But here asking by way of MCQs only. Hope you enjoyed today's section. Tomorrow we can meet again. Okay. Thank you for your patient hearing. Thank you, my dears. Kindly share the information to your friends also. Tonight itself I will share this Word document or the PDF or Word, whatever I prepared for question paper, question document, so that it may be useful for your better preparation. All are happy with the session? Yeah. Jagan as well as Sangeeta, thank you for your beautiful participation. Thank you so much. Good night, my dears.